So this is this a timing game? And I want to ask Capital Eric about that. But before we get to him, is this a timing game?
There's always a battle between the market, is the market going up or down, and the capital markets. Is money cheap or is money not cheap?
So what is money cheap or not?
Money is not cheap now. Money is super not cheap.
Said the senior managing director, Marcus Millichap of Global Markets. So I think we should listen to that one.
I'm willing to stake my reputation on that. No, I don't think it's ever been the case that interest rates have risen this fast.
So
maybe in the 70s.
So let's talk about the capital side. Okay, let's talk about middle market. My man Eric over here got some news. I mean, we talked in August, and we said at the time. All right, shout out to my watch guy Gabriel from Watches of Fifth, by the way.
Hey,
just a quick one. But we said at the time is we're at the bottom of the market in August, or we're going to be at the bottom of the market in 1 or 2 quarters. I mean, we're in the second quarter. You know, taxes are due April 15. Everybody pay your taxes. I'll get that extension. But, you know, April 15 is coming. And what's going to happen in the second quarter with capital? What's going on, E? Talk to me.
Well, first and foremost, I think it's important to understand that, Leo, you put together a great group, right? You've got yourself, you're in the trenches right now, in the court systems, discussing, bankruptcy and workouts and making mediation with those borrowers that are having distress right now. And your business is up. So that's an indicator that the distress is here. Now we got Dorian, whose responsibility is on when that distress occurs. You have liens, you have clouds of title. His responsibility is to see those transactions to see if they can move forward. Then you've got Eric Michael, who's making deals right now in the city. He's telling you that he's seeing short sales and discounted payoffs. That's inherently distress. And I think the audience needs to understand that. You have a discounted payoff, right? You, the borrower, took out debt. Your responsibility is to pay back that debt. You can't pay back that debt. The offer that you get on that asset is less than the balance of the debt. And Eric is saying that that bank took that discount. If that's not a fact of like people just blow their mind, I feel like it needs to be stressed. That lender took out 60, 70% of what they felt was the total value. And then boom, they're taking an offer less. They're saying it pays for us to take a short sale, take a loss. The lender lost. Forget about the equity. Those dudes are wiped out. The lender lost money. That to me is an entirely new shift in the market. And that's why we're here. And that's what makes this podcast so valuable is this is what is happening right now. Discounted payoff. I haven't heard of that. Let's go back to what you're saying on these springing guarantees, recourse, non-recourse, right? You do have springing guarantees on most construction financing and short-term debt, right. But it's when you do something bad, temporary restraining order on a TRO, springing guarantee, you do something stupid, that impacts the collateral, like you rent it up on a business plan that's supposed to be a condo. But otherwise, it should be recourse capital, right? Recourse, by the way, which Eric didn't state, is more expensive, right? The bank is like, yeah, we'll make it cheaper if you have a guarantee, because you're protecting us. You're going to come up with the money. You're not going to go belly up. So we'll charge you less. So people are looking at it and looking at their underwriting and trying to be less expensive. So if the collateral isn't there, but you're willing to stake, cash money up, the bank will make it less. Now, I think the third thing that we were talking about that I think is fascinating is that the market is adaptable. Okay. Everyone's bet today is that interest rates will stabilize and go down. Okay, so money is super expensive. We are looking at the lens of reality with our clients. We are telling them how much money costs. Put that in your pro forma and stop thinking that all of a sudden, like the fairy is going to come and make rates lower. This is what they are today, right? Underwrite that. See where you stand in the marketplace. But the market's adaptable. Lenders have to have to lend money, right? So what are you starting to see in the multifamily space, right? He's talking about CMBS capital. Okay, great. But CMBS can be long-term. They're trying to lock you up for 10 years in order to trade that paper on the CMBS market. So what we're seeing today sort of on this multifamily or long-term debt is more optionality. And the latest product that we're seeing that we think is like just really interesting to see how the banks are being adaptable is sort of short-term financing. 3 years, right? 3 years plus a 2-year extension, so 5-year money. Now, what would be the biggest problem to multifamily guys when you're looking at that type of capital? The biggest problem is you always pay a fine when you try to pay off early. So let's say you took a loan, it's 10-year money, and in 3 years, rates drop like a rock. When you go to refinance, guess what? The bank knew that that's what you would do, and they want to make sure that they got their interest, right? So they hit you up with these huge penalties. But now we're seeing these lenders going like, all right, we get it. We understand the product that you need. We'll give you a 3-year loan with a fee of like 3-2-1 on any type of penalty. And then you can take 2-year money because you can make a bet, like Eric was saying, on what will the future markets be, right? Is it that it will be less expensive or more expensive? And the last thing I'd like to say on that is I actually heard Barry Sternlicht say today at Starwood that they may go up. That's actually counter to what we're hearing, where everyone's like, oh, it's definitely going to be stabilized. It may go down a 1/4 point or a 1/2 point. But the fact remains, he just said it may go up. I thought that was wild when I heard it.
What may go up?
Interest rates.
So let's talk about that for a second. A lot of great things that Eric just discussed. I do want to talk about interest rates just for a little bit.
Just my last thing, because
Sure.
Dorian asked us, do you feel the heat? If you don't feel the heat today, consider yourself lucky, because the head of the comet, the biggest firms, are giving back assets. The middle market is giving back assets.
Is that true? Is that true, Eric?
Oh yeah, Blackstone is giving back buildings and giving the keys back.
And if that's not heat, then I don't know what heat is.
Brookfield, Blackstone.
Are they doing that because
These are
they're a
biggest,
banker?
biggest guys in the world.
Right, but aren't they doing that for their personal relationships
No.
with the bank? Or
No,
why don't they fight? Why don't they restructure? Like, what's going on with that? It's non-recourse. You said, right? You said non-recourse. I want to challenge that a little bit.
Yeah. These are non-recourse loans.
Yeah. So why are they giving back? Why can't they restructure them?
If the value is so much below the loan, they're going to give them back. There's just nothing to do. My experience is that you give the keys back. The business plan didn't work out. You were a good guy. Banks understand that. Even if you file bankruptcy as a small developer, mid-sized developer, a couple of years go by, banks understand that. My experience is when you sue a lender, banks don't like that.
Right.
Even if you're in the right, even if they did something negative, that's going to war with lenders. And
Absolutely.
if you want to keep your future options open to borrow, you got to think twice about doing that.
I like that. I like that phrase, because thinking twice is very important. But you have to think. Can you think twice when your entire value of your estate is on the line, right? Maybe you're dealing with.
I buy stock in Brookfield and Blackstone. They're incredibly well-run companies. Their stocks are up. They're making money, right? But there could be, like in LA, they gave back a building or two. It just didn't work out, right? But their portfolios are so huge, and their relationships with all these lenders are so important. They're not suing over one building. They're just not going to do it.